I've even adjusted, for currency to be fair. This is like-for-like basis, total shareholder return, so it accounts for dividends, those sorts of things. Over the last 10 years, Zijin plus 679%, light years away from the entire pack, and in second place, this is how far away second place is, Vale, plus 372%.
Righto, money miners. We're going to China. We're going to North America today. You boys are covering a couple of big dogs that are big and warrant discussion, would say.
Behemoths in the mining world that we just haven't really unpacked until today, but we're going to be the wiser for it.
Thank God for you two, because I'd never look at these two in detail. I just assume they're good. But I look forward to this.
We're not going to neglect the WA mining community either.
Oh, mate, there's been a share price plummet. And we're going to go in to see what the hell's going on. Oh,
let's do it.
Of course, I freaking own it too. Tell you what's going to bloody lift me spirits from a share price decline. The GRX conference, the Global Resources Innovation Expo. It is coming up 20th to 22nd of May in Brisbane at the Convention Centre. It's hosted by Austmine in partnership with AusIMM. What is it? It is the absolute nucleus of mining tech innovation, what the future of the mining industry is going to look like. You're going to have 150 exhibitors showing you everything, and it is going to look cool. Have a look at look at these photos. Look at these tech discussions in action. You are going to see shitloads of these. Look at these two. That is a highly engaged discussion about the future of the mining industry. And, mate, tell you what.
The conference is a portal to the future of mining.
Oh, mate, good pun there. Good pun.
It gets better though, Matty. Why does it get better for Money Mine listeners?
Mate, I love saying the word exclusive. Exclusive discount via us. $190 off the standard rate for members, $160 off if you're not a member, which means, look, it's worth the extra $30 discount to become a member. Follow the links in the show notes. This conference is bloody going to be unreal. You got to get there. Go to Brisbane, Vegas, see what the future of mining's going to look like. And
I might put my ticket now.
Mate, Rusty and Bryce should go.
Yeah. I'm sure they will.
They will
Bryce
be probably keynote. Yeah. Bryce is probably going keynote speakers.
Yeah.
100%.
I reckon if we could get the GRX logo on Rusty's nails, that'd be the go. That'd be the perfect marketing material. All right, let's get into it. What do we got? Take it away, Trav. Which Chinese company are we talking about today?
The mighty Zijin Mining.
Zijin, not BYD. Okay.
Not BYD, no.
Okay.
I wouldn't call them a miner, but we do talk about them a bit. But mate, Zijin is a massive mining company, and it takes a bit for us to understand it, I think. And up front, I think I'm admitting that I'm probably going to be wrong or a little bit off on some of my takes about Zijin, because up until today, frankly, I haven't done the work to try and understand this company, but it absolutely warrants it. It's massive. They have growing influence literally fucking everywhere in all of the commodities that matter. And it's a company that has grown enormously over the last decade. To kind of conceptualize just how rapidly this mining company has grown, in 2014, they produced 1.1 million ounces of gold. 10 years later, 2024, 2.35 million ounces of gold. So more than double the gold production. In 2014, they produced 138,000 tonnes of copper. 2024, they produced 1.08 million tonnes of copper. Like, that is just enormous copper growth when everyone's been trying to grow copper, they've just excelled at that.
Far out. I think I'll let you get to it, but I assume where a lot of that's come from.
Kamoa.
Yeah.
Amongst others, yeah. No other major has come close to generating the sort of shareholder returns along that same growth journey that Zijin has over the last decade. Keep in mind, this is a Chinese company listed on the Hong Kong Stock Exchange in a decade where capital markets have been very punitive towards Chinese equities. They've been, if you look at any performance of Chinese equities over the last decade versus Western equities, like atrocious returns. So, but what I've done here, I'm actually comparing Zijin, who is amid that kind of capital pool, compare their 10-year total shareholder returns with the majors BHP, Rio Tinto, Glencore, Anglo American, Vale. I've even adjusted, for currency to be fair. This is like-for-like basis, total shareholder return, so it accounts for dividends, those sorts of things. Over the last 10 years, Zijin plus 679%, light years away from the entire pack, and in second place, this is how far away second place is, Vale, plus 372%. It's not a time frame thing, right? I haven't just cherry-picked a time frame. Here's the last 5 years. Zijin, plus 592%. Second place is Glencore, miles away, plus 192%.
Oh, and that's bloody, considering Glencore in the last month or two, it's like 280 last night. It is like they're just plummeting.
Yeah. Here's the last 3 years, right? A different time frame. Zijin, plus 51% in first place. Second place, BHP, miles away, down 1%. Is that, coming off the back of elevated commodity prices back in 2022. Here's the last 1 year. Zijin plus 11%. Second place is Anglo, who, keep in mind, in that last 12 months received a bid from BHP, up 8%. So on every single time frame, no matter which one you use, the relative performance of the others, the pack, always changes. It's a different company in second place. But the constant on every single one of those time frames, Zijin has outperformed the rest. And I just find that utterly fascinating. So I've tried to spend some time today to understand how Zijin has such an edge over the Western incumbents that has seen it compounding at a vastly higher rate on every single time frame.
And that total return, that takes it for BHP Rio, that takes into account the dividends as well.
Exactly. Reinvest dividends.
Yeah, let's crack into why, mate. This is super, super interesting. I think you framed it well, and there's some really, really important reasons why to understand, like, and put it into context, I reckon.
I got secret sauce, and I think I can pin it down to five areas that Zijin that gives Zijin a massive edge that, like, honestly, I don't think it's an edge that is not replicable by any Western miner. Those reasons are: number one, Zijin has a cost structure that is vastly lower than its Western peers. Number two, Zijin's cost of capital is so much lower than any of its peers thanks to its access to Chinese state-owned bank debt at very low cost. Number three, Zijin has an envious track record of aggressive, shrewd and bold acquisitions while remaining tremendously disciplined on the price that they pay. Number four, Zijin's geopolitical positioning has enabled it to go where Western miners hesitate to conduct business, and they do it in a way that Western miners probably can't. And number five, capital allocation of Zijin has really prioritised reinvesting for more production growth as opposed to capital returns to shareholders that we've seen other Western miners participate in.
Yeah, for sure. Let's unpack that cost structure one, because that's maybe the most important. I mean, they're all pretty important, but that one's like kind of, once you kind of see it, you can't unsee it in a way. There's
so much to this, but if you think about a mining company, just like conceptually think of a mining company, they can't control the commodity price, right? They're price takers. They can't control commodity price. They can to an extent control their production units, and requires expertise and skill to do that. And they absolutely can control their costs. So I can't emphasize enough how important it is for a major mining company to manage their costs. In the case of Zijin, I think their cost structure is a true competitive advantage enabled by the fact that they have their own in-house engineering team to design, build and expand projects. They avoid third-party EPC contractors, and their margins that come with it clearly like disappear. So they can move much faster as a result of that as well. B, they have access to the entire Chinese supply chain. They source most equipment, materials, services primarily from domestic suppliers who are right on their doorstep. C, lean overhead. Unlike Rio Tinto, or BHP or Anglo, etc., all the rest, but they all have enormous corporate overheads, right? Teams on teams on teams that do nothing productive. Zijin's lean, right? They run a flatter structure with centralized control and lower corporate costs. In fact, its major shareholder is the provincial government, and they really discourage corporate bloat. D, and this is a big one, project location arbitrage. Zijin has prioritised countries with low wage costs and permissive regulatory regimes. Think DRC, Serbia, Colombia. Western peers have been, constrained by their ESG investors or the permitting dynamics in tier one jurisdictions, and they face longer timelines with higher community and environmental costs, be it both value and timing. And those locations have much, much higher wages. Like, these FIFO workforces are not cheap. JD, we were in the DRC. We visited the Chinese-owned mine, not the Zijin one, but they weren't. There was no FIFO rosters there. They were flying back to China once every 6 months. Like,
completely different, right? It's mind blowing, and like it can only kind of be done, some of these things from a kind of Chinese perspective or other kind of similar countries. Like you say, can't compete on a lot of those numbers.
And the cost discipline, it runs through the company in a way that I don't think others come close to. Just when you hear the rhetoric out of management, I'll just play an excerpt from the latest results call that shows you how obsessed with cost discipline this company is. This is English translation audio over the top of the call that I'll play.
So we have operations in 5 continents. And what we do is that we build a comprehensive logistic and procurement network for our project across the world in order to reduce our costs. And we have 2 concrete measures. For example, we use open price negotiation to buy some frequently used equipment, which also help us to reduce procurement costs. And we also take measures to control investment in construction. We set up an overseas cost settlement center. It is responsible for managing our prices and expenses early in the process overseas. And through this settlement center, we had put forward some feasible plans, which is quite helpful for us to improve our construction investment management. So we have managed to involve our management in overseas construction investments early in the process. And we also continue to optimize our designs and engineering. So basically, we have formed a very conducive cycle for cost control. And we also have this kind of full chain cost control measures. We also look into some abnormal prices in our contracts. Through this kind of management, we identify problems and lower them. And fourth, we step up our performance assessments regarding cost control. We set clear targets, and we also break them down into specific tasks. And for major operations, we also customize plans for their cost control. And we also introduce a sharing system in order to share our best cost control prices among our operations. And also, we will be able to improve our performance on all fronts. And we also introduce a reward and penalty system to ensure accountability and improve our cost control results. So basically, these effective measures will be continued to roll out across our entire group in order to further improve our cost control performance.
And also. There were so many things there, right?
She sounds excited.
Yeah, well, yeah. It was a female translator.
He. Yeah. Translator was pumped.
Yes. Yeah.
Yeah, that was fascinating, mate, and that flies in the face of the other ones, right? Because this is something Western companies can compete on, and I just love that dedication to cost competitiveness. That is, that's what really stands you out in any sector, right? And mining's obviously no different. It's perhaps even more amplified because you're a price taker.
So what about their M&A track record and and you speak of geopolitical appetite. We mentioned the Congo. They were obviously very heavily involved in the AVZ saga, which was fascinating.
Yeah.
So give us a rundown of that.
The two go hand in hand. And M&A, geopolitical appetite. Zijin, they've undoubtedly leveraged global diplomatic and financial reach to facilitate their expansion. Right, many of its projects align with China's Belt and Road Initiative or national resource security goals. Their largest shareholder is a provincial government, effectively, in my mind, making Zijin an extension of state policy. This government alignment, I think, has provided access to state bank funding support when investing abroad. I think host countries often welcome Zijin's investment due to China's ties or infrastructure deals in other parts of the country. And government backing, it also helps Zijin weather risks in these jurisdictions. In developing countries, it can negotiate like favourable tax or partnership terms, and it often partners with government-owned enterprises or offers host governments equity stakes to align those interests. Just think about the deal of the century. Zijin paid US $412 million for half of Kamoa-Kakula from Ivanhoe in 2015. Friedland himself has literally called this the best deal ever in mining, and he was on the selling side of that deal, right? He's no mug in negotiations either. So if there was more value to be had, I'm sure he would have found a way to get it. But Ivanhoe needed Zijin, and they brought not only the in-house engineering capability, but also a pathway to finance the mine too, but also a counterparty that has a manner to actually deal and negotiate and get things moving in the DRC in a period of time when no Western miner was going anywhere near the DRC.
And that's probably one of the most things that's misunderstood about Zijin, and acknowledge my ignorance, is that engineering capability that they're a project builder, which is don't think would be as well known.
And they can do it cheaper than anyone. They'll run their own numbers over an undeveloped project and come up with their own capex, which is way lower than the study of the Western miner put out for the Western project, and that can kind of support a case to pay X dollars or whatnot. It's totally not appreciated. Yeah, I think. Now, a lot of people would be quite critical of Zijin in the way their geopolitical influence may have let them achieve outcomes that are unobtainable to Western miners, and those critics probably have a damn good reason for their criticism too. Just ask any AVZ shareholder what they think of Zijin Mining. You'll be having that conversation for 15 minutes and not one positive word will be said. And I've no doubt that Zijin's achievements in some of the spicier jurisdictions have been facilitated in part by doing things that no Western company can do. And I wanted to convey how Zijin is also tremendously disciplined though when it comes to deal making. Can you guys think of a single deal where Zijin has been known to have overpaid for an asset or a company? I can't think of one, right? And how many major miners can you say that about? Like you just can't. At some point in time in some company's history, some management team, and it happens relatively often, they get very excited or too excited about one certain opportunity. They pay too much and it's a disaster. But I can't think of that as it relates to Zijin. And I just to capture that part of the DNA, I did just want to play a snippet from Chairman Chen talking about M&A in the current environment. This is a quote from less than 2 weeks ago.
I want to say is that even with such high prices, there are still some good offers available. So for a company, if it does not has any increase, then it won't be able for the company to achieve growth. So we will definitely continue with our M&A strategy. Zijin has this feature, which is that we won't go for very expensive project. We won't bet on just one project at all costs. For example, when we decided to enter the lithium market, that time lithium prices has been quite high, but we still evaluate projects at the cost of 100,000 per ton. So this is our benchmark price internally. Basically, it means that we will still remain prudent in our investment strategy. So we have some considerations. For example, in terms of the selection of minerals, we will go for minerals that is optimistic in the future. In recent years, we prioritize copper because it's critical to renewable energy. And also, artificial intelligence, the application of AI also consumes a lot of electricity. And geopolitical factors are having greater impacts. Almost all central banks across the world are printing money. So money is cheap, and that is why we are seeing rising gold prices. So gold is a very important target for us in our future M&A activities.
Got to get Chairman Chen and the translator on the show. That'd be a bloody...
Wouldn't it? It would be a very interesting conversation, I reckon, Matty. But like you can hear the discipline there, right? Like how many companies were running 100,000 CNY per ton lithium carbonate in their long-term price assumptions when it got to 6 times that, Albemarle certainly didn't.
What do you think is going to be some of their next moves? Like if you're going to throw some darts around, what are they? Is it going to be heavily focused around copper?
They had a massive swing in lithium, relatively massive, almost $2 billion deal. Yeah, Chinese lithium for Zhangye.
Yeah, they've got he spoke after that quote, how he's pretty happy with the quantity of lithium resources that they have, and I'm sure that they've got a view on the extent of the MOMNM deposit they'll be able to bring online. They've also got Argentinian brine, which they're bringing online as well. So there's they're quite comfortable with their lithium deposits, but they're happy to look at more. Gold said was a big priority. I think gold is actually like higher priority than copper based on my interpretation of the translation. I also think where they are going to look for, they just bought Newmont's AusIMM mine in Ghana, by the way, paying $1 billion for that, and but I think they'll find a lot of opportunities in South America. Places like again spicy jurisdictions like Colombia, those sorts of locations. I wouldn't be surprised to see a lot more activity from from the likes of Zijin in those parts of the world.
What about Ecuador?
It's entirely possible. Yeah. I can see that.
Absolutely.
Yeah.
Mate, that's fascinating. That is super, super interesting. Obviously, with the M&A aspect of it, they haven't been around as long in such scale. So very keen to see how they do through the next cycles in staying to that discipline. But the track record is super impressive. Yeah,
it is. And I mean, they're even in Australia and like via its mostly owned subsidiary Norton Goldfields, which is a funny one, a bit of a head scratcher. I think they've got a pretty high kind of cost basis that they run things at there, but have also shown a willingness to divest for the first time in a long time by way of selling bulling recently to MI6. So I'm paying more attention to Zijin. Paying a lot more attention, and I'm kind of convinced that they do have a competitive advantage that Western miners can't imitate based on all of the factors that I talked about, for better or for worse.
Very good, mate. Very good. JD, we're going international again. We're heading to North America for you. But before we do this, I have a bit of an itch to scratch that I have not done for a while. Check this out. ITs, more ITs flying out the door for KCA. It's bloody good to have them back, and tell you what, these IT numbers have just grown since we've had them.
How many are they going to?
38 ITs. 38 more coming in 6 months, and that is going to complement the frickin' underground Agi coming in the next month, and the bloody underground charge wagon coming in the next month, mate. All available for hire. A new grader on the way, mate. They're going to be at underground operators. I cannot wait to see them. It's great to have them back, and they've even just amplified the recruitment team. All your blue collar workers for underground, open pit, civil, construction. They're just, mate, whenever in doubt in your life, what do?
Just call KCA.
You call KCA. Very simple. Great to have the team back. Oh, mate.
How good is that?
ITs flying out the door. Right, JD, where we going? North America. This is a big humdinger of a... Yous love this company. Yous love it. I know yous love it.
I do. I've got to sort of turn the volume up after you've just done the ad again. So normal. Very good. We're talking about Franco Nevada. So... they just had an investor day. I'm not sure if you guys saw this one, but I thought it'd be worthwhile just tuning in and trying to learn a bit from the royalty behemoth that they are. So I think everyone kind of knows their returns are first rate. They're pretty stellar. Their share price performance since the IPO kind of knocks it out the park. And I was kind of curious to hear how they're thinking in like a frothy precious metals market, and some of the other perspectives on debt, on the market and sort of funding structure more broadly from juniors to developers. And yeah, I thought it'd be good just to chat with you lads about the big takeaways.
I'm very curious, mate. Where should we start?
I've sort of jotted down a few points, and it's actually interesting to look afterwards. There's a sort of relation between all these points, which I think the money miners will kind of notice as we go through. But I'll start with how royalty funding has its sort of place versus your traditional debt and equity sources. And what you kind of take away from this is the timeframes when Franco in certain commodities will get really active. So I'll play a snippet from the CEO to start us off.
That we can provide capital to the industry at a consistent cost. There'll be times when debt is very cheap, and then we can't compete, and we're happy not to compete on that level. There are other times when debt is far more expensive, and then we can compete. So we prefer to think, both when we're competing with debt and also with the equity markets, that we're a consistent cost of capital. The equity markets probably even more open and shut than the debt markets. There are some periods where they're wildly undervaluing assets, and there are other periods where they're overvaluing it.
So my interpretation, keen to hear what you guys think, but that was just speaking to discipline, like discipline through the cycle. You've got to stick to it. You can't change your strategy kind of halfway through. And he ended up following up that bit there by sort of saying, when people really need our capital is when we get deals done. And I found that fascinating. You guys can kind of chime in if you've got thoughts, or we can jump to the next one.
I totally like that. You know what comes to mind when he said when people really need us. I think of Sibanye late last year when they did the stream, which was pretty onerous, but it just kind of speaks to the value of a royalty company.
Absolutely, and it's going to tie in. And I've got more thoughts that I'll sort of piece into what you said as we go, but I'll speak to their view on debt. And in simple terms, they avoid it. It's as simple as that. The goal is to be the one with capital when you're in those cycle troughs. And some of the best deals that these guys have done when other companies are distressed. So thinking like Glencore 2015, 16, those sorts of deals that they do stand out, and they make your money for years and years and years afterwards. So they view not holding debt as a competitive advantage in the business, and it's Berkshire-esque, and that is kind of the utmost compliment in my mind. But it's really how they view the world. And they got asked this question pretty early on, or they actually spoke to it actually without being asked, because debt must be such a tantalizing prospect for a business like them, right? And the idea that you could just spruce up your returns ever so slightly year in, year out is, super, super appealing given the profile of this business. But they clearly acknowledge we are in one of the most cyclical industries that exist, and they view that financial flexibility and the ability to move quickly when it really, really counts far exceeds the ability or the earnings in the long term that you're going to get from a few extra percentage points here and there. So I'll play another snippet now.
The second is financial flexibility, and it's how we think about our balance sheet. A lot of folks say to us, why don't you lever up the company? Debt is a lower cost of capital. You can get better returns that way. That's not our approach. We put more importance on financial flexibility than we do on cost of capital. What we've found over time, the industry is highly cyclical. There are points in the cycle where the industry really needs capital. That's where you get your best deals done. For us, that's happened twice. The first was 2008, financial crisis. We had the capital available. We made some super investments. Palmarejo Guadalupe was one of those. The second time it happened was 2015, 2016. China slowed down. Many of the diversifieds were caught offside with their balance sheets. We were able to get stakes in terrific assets, Candelaria, Antamina, and Tabakai.
Mate, that's really interesting. I think it speaks to the optionality that cash has, but also, they're in a competitive industry where the ability to act fast in those moments of distressed opportunities matters so much, right? You've got to, and imagine if you've got a peer royalty company who doesn't have a debt covenant in place, and they've got just cash that could be deployed, but you've got a debt covenant. You've got to get your lender to look over it because you want to kind of maybe allocate more than you thought you could for all of those sorts of reasons. So I think it's a function of their outlook and also the competitive nature of what they're doing.
So that flows on, flowing on from that, you've got investment cycles. And I'll just underline what Paul said there. Investing opportunistically in the weaker parts of the cycles, in particular for non-precious metals, they've got a slightly different outlook for gold. But the Detour Lake deal, I just want to underscore to put it in numbers for people to understand how good a deal this kind of was. They got a 2% NSR on it for US $35 million. This mine did 670,000 ounces last year. They call that a 250x. It's just kind of phenomenal. And then there's, the big South American copper assets that they spoke to as well, which are kind of stellar. And gold, like I said, is viewed a bit differently, which I'll get into in a moment. But the way they sort of talk about this is investing through the cycle, and they always present their board two price decks. One is more or less the spot price, and the other is consensus. So it's a bit of a different take to the other commodities. And to piece it together for people, they kind of want to maintain gold and precious as 70% of their portfolio and 30 as other commodities. That's predominantly energy as well as copper. So my fourth point is ignoring the rate of return. And this one is super, super interesting. So the upfront investment will always seem to have a low rate of return is how they frame it. And adding to that, they say whatever you put in the spreadsheet is going to be wrong. So their process is kind of two-step. Firstly, are you highly confident that you get your money back? And secondly, have you picked a property that can be multiples of its current size in future? And they sort of say that in this business, that's where you make all the returns. So I'll play it from them.
Key thing when we're looking at projects, are we highly confident that the project is economic, that we will get our money back? The number one thing that we think about as a business, as I said up front, is it's not the rate of return that you see on what's there today. It's investing in the right properties that can be a multiple of their size over time. Because if they are a multiple of the size, that ultimately is where you make your returns in this business.
There you go. Don't fluff up your study too much if you want Franco to come in.
If there's like one kind of word that describes how this company thinks best, I think it's optionality. That's what they prize over almost everything else. And you're targeting projects, assets that will last multiple cycles. And it actually reminds me of this paper that I think we shared a little while ago from Copernic, this US fund, on how many people out there have flawed valuation methods for mining companies, and they don't appropriately value the longevity and the optionality that you get in these top quality projects. And I think it's something super interesting to hear it acknowledged from them. They've always sort of spoken about it, but to hear it is just reinforces it in my mind.
I think if who benefits from that optionality the most, it's actually not the miner, because their costs creep up as time goes on. The royalty company captures so much of that in a non-linear fashion of that optionality, because it doesn't matter if mining costs go up, doesn't matter if inflation happens on costs, because the royalty is a percentage of top line.
100%, mate.
So if this is such good business, how is it perceived if a mining developer or company has financing from Franco and a royalty for them forever? Is it like, if it's so good for Franco, is it bad for them? What's the
That's a really interesting question, Matty, and it ties into my final point on gold versus other commodities. But to answer your question directly, they are trying to stamp projects these days and kind of have a bit of brand power, which I never thought we'd kind of speak about on a mining podcast. But they want to give projects the Franco stamp of approval, and they try and frame it as that having positive flow-on effects for a company's cost of capital because Franco's done the work. Now, take it with a bit of a pinch of salt. They're getting the better deals there, and the miner is going to pay in any case to get that stamp of approval, right? But yeah, it's a double-edged sword, right? It means that Franco's done the work, and they think this project is going to be around for a long time if they're buying a royalty directly, if they're teeing one up with the company. It goes both ways. So we go back kind of 20 years ago, and they're one of very few royalty companies around. It's a less competitive space. That has changed quite a bit. There's more royalty companies around today, and the little royalty companies that are around are even bigger. And then you've also got more competition from the likes of sovereign wealth funds and these alternate sorts of capital, your Orions of the world, your Appians of the world, those sorts of guys that are coming in to try and compete. But at the same time, you've got a dearth of gold funds. So the number of pure play gold funds or mining funds that are around now is a much smaller number than it was 20, even 10 years ago. And the capital that they're managing is substantially smaller than it was. So the landscape has changed quite a bit. But as these guys, Franco's position has grown, as they've become a bigger company, their cost of capital has sort of gone down. They've become even more competitive, so they can kind of do deals a little different. But yeah, it's a fascinating kind of landscape, and you can just sort of view how mining finance has changed as these guys have grown.
Yeah, right. It's a sounds
that was a long answer to your question,
but
mate.
It sounds like a good marketing strategy to say, look, just attach us to it. It just looks better because we sound like we've done the DD on it, but we're going to make shitloads over the long term.
Yeah,
it's fascinating, isn't it?
I don't think we'll ever look at a royalty on a single asset developer royalty finance and be like, yeah, this was a great finance. We're just because of the way that it inhibits a project into perpetuity. But sometimes a single asset developer, or even multi-asset developer, if you think in the case of First Quantum bringing on Cobre Panama, they had to put a big royalty stream, yada yada, on that, thanks to Franco too. sometimes you have to do it to get the deal done.
Yeah, is it perceived?
Goes to the first point. Just goes to the first point. You know, they do the deals when, you know, you need the capital, you being the miner.
Yeah. Is it possibly perceived a less risky option than conventional debt or dilutive? And so it's a short-term benefit, but Franco gets the huge long-term benefit of it. How's it perceived from a funding dynamic?
It does have elements of that for sure. Like you don't have to pay it back, right? So that's not going to come and sting you at the bottom of the cycle the same way high-cost debt will. No doubt about that.
Yeah, it's a fair comment. Yeah. In another perspective, it makes your corporate appeal a lot lower too, because a major's going to be less hungry to buy something because the royalty outlives the corporate outcome.
Yeah.
You can always spin a narrative as well, mate. You can sort of say, "Oh, we're a copper miner. We weren't getting credit for our gold anyway, so we just streamed off the gold." That's exactly how Sibanye framed it. You know, they're saying nobody cares about the gold that we produce in the bushveld. We're a PGM miner. That's how people think of us. So we'll stream off the gold. So you can spin it a few ways.
Yeah. Yeah, that's bloody interesting. Very, very interesting. Good digging. Good digging as always. You want to know another bloody stamp of approval that's probably worth its weight in gold up at Franco levels? MMS stamp of approval.
Tell me, Matty.
But if having them associated with your project, look, Black Cat has cracked $1. And that is either to do with one or both of MMS's open pit mining expertise at Myrie, or the tech services arm that complements it, which has probably been a significant driver to why they've got to the ore so early, and they're just going to finish it that far ahead of schedule. So you're talking about stamp of approvals that actually hold some merit in Australia. It's bloody Mineral Mining Services doing your open pit mining.
It's amazing when you think about it, because Black Cat would, I don't know, maybe even just only be focusing on Paulson's if it weren't for the innovation that came from MMS, helped them kind of get that going, and then all of a sudden Black Cat's like, heck, we might actually buy a mill here because there's a fair bit of upside going on.
The flow-on effects. Mate, that's like great decisions for perpetuity. It's like open pit mining royalty. And look, they will acknowledge that MMS were instrumental in that process. So, mate, if you want to follow a similar trajectory, get MMS doing your bloody open pit mining. Mate, there's going to be, I don't know if they're going to be doing mining here or not. Oh, no, you got a bit more final thoughts, JD. Or do you?
Yeah, I had a couple just to wrap up on.
Rip them out, mate.
On Franco. So real quick, I didn't speak about Cobre Panama because we touched on it, but that was 15% of the company's NAV not too long ago. You just go back a couple of years and things are heading in the right direction there. So watch that space. And finally on Franco, you know, their strategy has been superbly executed to date, and they've outperformed almost every Goldie as well as the metal price since they listed. So keen to see if they can maintain that discipline going forward. You know, you'll constantly have to kind of do new deals here and there that knock it out the park. So we'll see on that front. But the stock itself can be super pricey. Hence they pay dividends. They don't buy back their stock. I think that's a bit of an acknowledgement in that. There are opportunities, though, in times where these guys have done deals, like they said, 2008 and 2015-16, their share price has been pretty depressed as well. So you can, here and there, you know, it's kind of once a decade type thing, get an opportunity. But in normal times, I think as an investor, if you are looking at kind of investing in Franco Nevada's stock, you are paying up quite handsomely for the optionality in their portfolio, which ironically, I think is something that Franco's management team themselves would never do. So it's a kind of interesting paradox to leave it on, I think.
Very good. Got us all thinking, JD. Nice work. Right, everyone's thinking.
Let's talk exploration, mate.
Exploration, geez, everyone's thinking, why the hell's this gone down bloody 30%? Oh, Caprice, one of the early gold exploration bolters, has unbolted a bit. Well, it's sort of back to where it was before these assays come. Let's go. There's a pretty interesting sequence of events here. So they got the ground up near Ramelius's Break a Day up in the Murchison. So when now that gold's $5,000 an ounce today, Aussie. Wow. Which is fascinating that the gold stocks haven't moved that much. So whether old Trumpies the fear of tariffs on the whole world is offsetting the increased gold price. Could be a reason, but it was fascinating to not see the equities move as much. So Caprice in the leader, they had a busy 28th of March. This was which was last week. They put out because I was sort of running. On no news pending assays, they got up to like 8 and a bit cents, and they released these incentive securities for the directors, 2.5 million performance rights each, and $500,000 to the COSEC as well, I think. But on the same day, the price was running. They went into trading halt. Pending price query and assay announcements. Everyone's thinking, Jesus Christ, they're bloody issuing performance rights just before assays. Looks a bit airy going. But then on the same day, the 28th of March, they then withdrew the proposed incentives. So those incentives were based on the company shares trading above 10 cents for 15 days and at least 1 year's service. So it was nearly approaching 10 cents. So, but it has retraced today. It's back down 30 odd % on the release when it came out of trading halt on the release of the assays. So you look at the first page and you're thinking, 11 metres at 6.7, that doesn't look too bad. 20 at 1.5, not as good. 28 at 6.4, but that was the previously reported result. And then they had a few other results at Baxter and everything, 10 metres at 3 grams. But if you look at, I guess you bring up the cross sections and see, right, what's new, what's old, and how's it all looking? So I guess the main one they were going off was this Vadrian's Hill. That was where the 28 at 6.4 is. And you see the new results that come out in the yellow. So you head north of there, it goes to, well, I guess the follow-up hole of come back at 20 at 1.5. So it looks like, right, the grades dropped off there. They did a bit of drilling on the surface in another spot. They all come back as dusters, 5 at 0.3, 8 at 0.2. So, and then that Baxter prospect, they, again, going deeper, results of 7 at 0.46 and 3 metres at 0.4. So it's sort of just the results today didn't really match the, I guess, standard of the initial results that came out that sort of saw the share price triple. So it's just looking like that's their phase 1, phase 2 program complete of 5,000 metres. They've got a phase 3 follow-up of 5,000 metres scheduled to start next month. So there's obviously, this is early stage, the volatility of exploration. So there's plenty of ground there they're going to pepper holes into, but it just shows hype can very quickly turn into unhype when this gold exploration mania market. So be interested to see if these performance rights, when they do get granted, if they're still on the exact same conditions.
Yeah, because the share price is a fair way away now.
Yeah, it's down 30%. So you would hope they come back out at 10 cents as well. So
Very interesting.
We will wait and see. So that's
you saw the series of events and you thought, there must be something good to come here, but nope.
Yeah, it's it was bloody, very interesting. So anyway, see what they do in another 5,000 metres, I'd say. There we go. Go gold, go exploration, $5,000 an ounce. LEGC's frigging off ahead. She just can't sit still today. She's flying.
It's gold coming out of her ears.
Oh, that's what the Ali G's got to be. The G stands for gold now. Ali Goldavitas. Oh, right.
Nice
there
work,
we
lads.
go. There we go.
We'll see where gold finishes the week on this insane run.
Oh, you can tell I just whipped that up right at the end just to put something in to complement your extensive segments. So, anyway, got to give a bit of love to everyone. Right, let's go through the friggin', speaking of ITs flying out the door, we've got ticket discounts flying out the door. We've got the GRX conference, which we mentioned at the show, $160 or $190 off. The future of mining innovation at Brisbane in May. Get your tickets to that. AusIMM Underground Operators Conference next week. I've got the gather round heading to that, the resource rise and sale one. After that, I'll be a bit hoarse. Apparently, I'm bloody hosting a panel with Koshi.
Wow.
Me and it. I'll be like, hey,
Mate, the young
gone
bull.
are the days of sunrise,
after
mate.
a conference.
Mate, you're in my world now, Koshy. I'll be doing the Carl Koshy role on that one.
Teach him a thing or two. Hey?
Yeah, mate, I'll show him who's boss in the mining industry. Right, who are all these bloody bosses of the mining industry? Mineral Mining Services, Grounded, Sandvik Ground Support, CRA Insurance, WA Waterboards, Quattro Project Engineering, KCA Site Services, Black Diamond Drilling Services. Love that. That sounds good. Black Diamond. And Cross Boundary Energy. Hoodaroo.
Hoodaroo, guys.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.